Hi, I'm Steve Breen with Prosperion Financial Advisors. This past March 9th, 2015 marked the 6th anniversary of the last market correction. On that day, the S&P 500 was at 676 versus today at 2100. But the significance of the 6th anniversary is not one of value, but of time and frequency of corrections. You see, historically, there have been 14 corrections in the past 70 years since World War II. Do the math. Works out to be about 1 every 5 years or so. So looking at the calendar, it seems like we may be overdue for a scheduled correction. But unlike the dentist, the market doesn't schedule an appointment with investors a year in advance. As a result, we're not sure when our checkup is due. But I believe we can be certain of two things. First, it's certainly coming at some point. And second, some people will wager their retirement portfolios in an effort to time the market, likely missing out of the top and the bottom while managing to underperform the overall markets. It's been my experience that those who try to time the market typically end up worse off than if they'd have just stayed the course. Market volatility is something we neither can control nor predict. What we can control is how we react to it. In my view, declines are always temporary and advances are always permanent. Historically, we have many examples of that, such as the night before the first decline back in 1946, some 14 corrections ago, the S&P was at 19. Today, again, 2100. The dividend then was 70 cents. Today, it's $39, up 56-fold versus inflation up 13-fold. This furthers my belief that investing in a long-term proposition, and investing in a portfolio of growing dividend, growing income investments can help protect your purchasing power. But that doesn't stop people from trying to time the market. Some resort to things such as the calendar or what the return has historically been. Both are nonsense. Going back and looking at all the bear markets since 1926, the average time from peak to trough and back is some 3.3 years or 40 months. The 14 bear markets since 1946 have averaged minus 19 to minus 57, or about a negative 31%. If you exit the market when we're officially in a bear market, down 20%, 2/3 of the decline's already behind you. You're selling late. Then comes the decision of when to buy back, and usually the same false readings cause you to buy late. This is a vicious cycle that destroys portfolios over time. So what should investors expect? Historically, there are setbacks every 5 years or so. It's entirely predicated on investors' ability to ride out those temporary declines, which determines how well investors will do. So, should we be looking at the economy or our portfolio? Well, the American economy is expanding. Once again, we are the growth engine of the world. I believe that dollar-denominated assets are one of the best places to invest right now. Bull markets don't end necessarily when valuations are slightly above their long-term averages, as they are today. Instead, it's been my experience that they typically end when we're at a performance-at-all-cost investor mentality. I just don't see that today. Consider these three charts that illustrate consumers and investors and how they've delevered and de-risked their balance sheets. You can see from the first chart that investors' financial obligations, like their mortgage and consumer debt, have fallen since 2008 consistently. And from the second chart, overall investor household leverage has fallen. And this third chart, the real per capita net worth, in other words, what you're worth, has recovered nicely and is in line with the long-term historic growth rate. So in conclusion, episodes of volatility, they're uncomfortable, but they're normal. It's the price we pay to be an investor and part of the economy. Instead of fearing the inevitable, plan for it. When the time comes, keep a level head and stick with your plan. It's the best way to plot a successful future course. We welcome any questions you may have related to your portfolio or your progress. And as always, thank you for being a client of Prosperion Financial Advisors.